So my name is Rod Turner. I am the founder and president of Manhattan Street Capital. And we are the hosting platform and project management and advisory service that is supporting and helping make the ERC home builders offering happen. And Jerry obviously is here also, and Jerry is the CEO of ERC Homebuilders. So I'll be interviewing Jerry in this session, and we'll get going with that roundabout now, I think. So just a couple of legal disclaimer things. This is a Reg A Plus offering that the ERC Homebuilders has, hence the text that is in the chat box that I'd like you to read. Manhattan Street Capital is not a broker-dealer. We are an offering platform. And so there are restrictions on what we can do and so forth, but you would expect that. Questions and answers I mentioned, and that's really about it. In terms of getting started, I think probably, let me see what time we're at here. I think we should get started, Jerry. So
yeah, fine with me. Welcome everybody. Yeah, fine with me.
So Jerry's gonna, please Jerry, give us an intro to the company and give us, a summary of it, and then I'll ask you some follow-up questions.
Well, yeah, thanks for joining everybody. I see we've got a pretty good sized group here. ERC Homebuilders is raising capital through Regulation A Plus through Manhattan Street Capital here to provide funding to allow us to develop and construct neighborhoods, commencing in Florida, but ultimately around the country. Neighborhoods that will rent homes out exclusively to tenants who would rather live in single-family homes than apartments, and then upon completion of these developments, sell these neighborhoods off to financial institutions, to rental owner-operators. Given our development and construction knowledge, let's say, our development and construction expertise, we have an ability to take your capital, mix it in with mortgage capital, and build these communities for quite a bit less than what the broad investor public is willing to pay for them. And it's a very profitable business. And so investors who come into this should, I can't say you will, but by federal law, but you should see your shares accrete very nice value over time. We are incorporating some very unique, affordable factors in how we're developing and constructing. Our neighborhoods are going to come together very quickly. We are running reservation systems on neighborhoods that we're commencing development on, and the first one we're doing right now, we haven't even broken ground on it yet, and it's almost 100% reserved with tenants. And so it means it'll fill up very quickly, and it'll be a very prime, it and ones that follow will be very prime candidates for what we call institutional buyout. By and large, this is not a company that is going to build these neighborhoods and collect rent over time. Ultimately, down the road, we may get into that, but for right now, your shareholding money is going into this scenario that I just described. Develop the land, bring the construction in, get the homes built, fill them up with quality tenants, and then in many cases on a prearranged basis, sell these communities off to larger owner-operators of real estate and institutions who have very high demand and interest for this kind of property. I mean, I hope that describes it, Rod, pretty well.
Yes, it does. Yeah. Could you and I talked the other day, and you were discussing the interest level that you're getting from partners in funding developments. If you could shed light on that without let me just give the audience a bit of clarity here. In a Reg A Plus, we can't predict things that haven't happened, but we can discuss the context, which is what I'm asking Jerry to do here, because what you were describing was pretty exciting, with the caveat that it's not a done deal yet. But if you could give a little bit of a sense of that, that'd be good, Jerry.
You mean the interest we're having from other financial groups?
Yes.
Yeah, this may be unique to this offering, but it's very critical for everyone on this call to understand. You all on this call either have invested or are considering investing into this company. Your capital sits in this company, and in ERC Homebuilders, and ERC Homebuilders is using that capital to buy assets, buy land, develop it, fill it up with tenants, and then sell it off. The nature of this development product we're doing is such that large financial institutions have great interest in this and have reached out to us in multiple form, as many as 7 or 8, 9. I just had a conference call yesterday with a major one. I'm not allowed by virtue of confidentiality agreement to describe who they are, but they're major financial groups who wish to joint venture with ERC Homebuilders. So it's an interesting notion that your capital, the expression we use is that your capital has good company. It means that it's being, potentially melded together in joint venture format. The Securities Exchange Commission has various rules by which we do this. Our law firm guides us through the various structural issues to make sure it's all done correctly. But to the degree you are investing in this company, know that there are some major institutions who are also, or who are planning to also. As Rod will confirm, as some of these relationships consummate and those funds are received, we will of course announce that across the Manhattan Street platform, so you'll see who these institutions are and how much they invested, and it will propel the growth that you're looking for in this investment. We're frankly very proud of this, Rod, very proud of this popularity that our company has with institutional investors.
Yeah, that's good. Thank you. You said that in the right way. You gave the context as well as the caveats. Well done. Could you explain to the audience what is the nature of their return? Not sure how aware they are as to the combination of the return on ERC Homebuilders.
Investors should be looking at this company to deliver them two principal things. Number one, an 8% annual dividend that is paid monthly. For example, if someone invests $3,000, 8% of that $3,000 is $240 a year, and that $240 a year is paid $20 each month. We have paid that dividend out now for quite some time and pay it regularly each month. We did front-end reserves to establish a reserve, at the front end of this company to pay it before we actually even started development. So what I would call it, Rod, is your direct return, your objective direct return, your objective direct kind of immediate return is this 8% dividend. It has certain tax advantages in the first couple of years. So that would be reason one. Your second reason for investing in this would be the growth factor that may exist. Again, under federal law, I have to say may exist. I can't say will. We're obviously very confident that it will, but based upon our past experience. But you should see a growth factor, both the growth of the dividend over time, and then growth in the value of the stock. Perhaps years down the road, there'd be ability to sell your shares for a higher price than you paid. We do not get involved in that. We're not allowed to express any opinion on that. But the company may have certain value. There could be certain things that occur, should be certain things that occur, where your shares are actually worth more than you paid for them. That is called growth. So this investment has a rather immediate income potential of the dividend with a possibility, we think a very good possibility of growth, so that you have a multiple of your investment down the road. You're not going to see that in 3 to 6 months. When I talk with investors a lot, I take phone calls from prospective shareholders, and I tell them to think of this as a 3 to 5 year hold, a 3 to 5 year investment where you'll see the investment go up. If you're looking at me now, a graph would kind of go like this. It wouldn't be straight like this, but it would go up like this as we multiply profits and reinvest the profits to keep developing these communities. We have a very serious business plan here of doing a very good volume of these, depending upon the capital that we procure. I hope that answers that. I get accused of long-winded answers.
That was good. That was good. Can you talk to how the COVID-19 world we're currently living through is affecting business?
Well, we have a pretty direct example of that right now. I hate people who use catastrophes such as this to, to exploit economics and say, well, hell, we can make profit on this. And certainly that is not why we went into this business. But we do have an interesting byproduct here. The byproduct is that if you look at a progression of housing today, you take a young adult, goes up through maturity, living at home, goes to an apartment, maybe then goes to a rental home, then goes to maybe purchase a home. So we're in that middle there. We are observing in our discourse with residents who want to perhaps move into our communities, an increased desire to live separately, Rod. This is separate living is becoming a bit of a, I want to call it a survey button. It's becoming an interesting survey answer. We don't ask these people, geez, is COVID the reason you're moving in here? Obviously, we don't ask that question. But we are seeing tremendous demand here. You drive up and down the interstate, you drive up and down any major thoroughfare, any major city in America, you see a tremendous volume of these 3- and 4-story clustered apartment buildings. They're everywhere. There's a whole economic reason why that has occurred that I don't have time to get into, but that's very condensed communal living. And there seems to be interest now in separate living. We are now going to, because of some affordability features we've been able to bring to our platform, we're going to be able to deliver the same square footage as a good-sized apartment, say a 1,400 square foot unit, freestanding, all by itself, 3 bedrooms, 2 bathrooms, double car parking, and we are probably going to be renting that for less than that family would pay in a brand new garden apartment, same size. Not only less than a regular home rental, but now we can assert that we will be renting for less than what they'll pay in an apartment, and they are living separately in their own home.
Thank you. That's good to hear. Could you, what was I going to ask you? You talked about Florida earlier. What is the reason, economically speaking or strategically speaking, why there is high demand for this kind of housing, apart from what you just said about COVID having an effect on it? Because there was already significant demand, wasn't there?
Yes. The general demand for rental housing is a function of a handful of things. Let me list them not in any priority of order. Number one, everyone should know that this does lean towards the affordable side of the marketplace. We're not talking about families who can afford to buy a $700,000 home and pay $5,000 a month to live there. We're not dealing with that. We're dealing with entry-level housing, young families who may want to buy a home later on, but right now probably can't afford to, may have student debt, may have low credit score, may not qualify for mortgage financing. So you have kind of, number one, we can't afford to buy. Let's call it that. We can't afford to buy. Number two, I happen to be from the tax area. I'm a CPA, and so I have great tax knowledge that will just bore you all to death. So I'll try to stay away from that. But under new tax law, the second reason is that under new tax law, many of the tax incentives of home ownership are gone. If a couple buys a married couple buys a $300,000 home today, all of their property tax and interest deductions on their tax returns are lost because the federal government gives them a standard deduction that is higher. When I was growing up, when I was young, these interest and property tax itemized deductions were critical in the filing of our tax returns and had a lot to do with why we'd buy a home. So reason number two is that the tax incentives are gone. Reason number three, when you look at millennials, these 20s, 30s, and 40-year-olds have a different thrust of where they want to put their money. Do they want to make a major down payment on a home? It seems that is evaporating a bit, that interest in owning a home may not be as acute as it used to be. And the fourth reason is that, again, baby boomers like me coming through the 70s, 80s, 90s into the new millennium, we're watching homes double, triple, quadruple in value. Homes where I come from, the Bay Area, California, homes that were selling for $50,000 a few decades ago are now worth $1 million. That growth in value is not present now in the current economy. We're not going to see that kind of growth. So it's affordability, it's loss of tax, it's desire of what they're spending money on, and then finally a dissipated growth factor that simply has more people wanting to rent at all ages. Frankly, it isn't just young people; it's seniors as well. Much greater desire to rent, and that is just a new consumer demand, Rod, that decades ago wasn't there. Renting, may I add, renting was a necessity before. It's now more of an option, at least in my opinion.
Yeah. So when you say, I'm not sure I know what you mean there. You say renting was a necessity before?
I think when people rented back in the 80s, 90s, coming into let's say the 70s, 80s, 90s, people were renting probably because they had to.
Yes.
And they were looking to end up buying. We want to buy. Now it's like, well, we're not sure we want to buy. Right. Even people that have higher income levels are we're just going to rent. We're going to use our money for the stock market or something else. So there's it isn't just affordability. It's electability. People just electing to not put their investment into a home and rent and use their money for something else.
The company has made a couple of announcements about developments that are underway. Actually, I'm not quite sure how many. Could you touch on those? Could you add a little bit more flesh on the bone for those announcements to the group?
Yes, ERC's first development is in Zephyr Hills, Florida, a lovely little suburb of Tampa, probably about half an hour out of Tampa. Also, close to cities like Plant City and Lakeland, which are on a very popular interstate called Highway 4. It goes from Tampa to Orlando, very ideally situated, very Midwestern type of little kind of downtown village, very cute. We're developing 60 units there. We're going to rent these homes out around $1,390, $1,395 a month. We're closing escrow on the land in the next 5 or 6 days. We'll probably break ground beginning of October. This community has 60 homes available, and I think as of last night, 55 of them are already reserved. That I don't want people on this call to think that all 55 of those families will move in. But what I want you thinking, when you hear something like that, is I want you thinking, wow, that is some pretty interesting consumer demand. By the time we break ground, we'll probably have a double waiting list. And again, as a landlord, I've been a landlord all my life. When you have that kind of demand, it allows you to be quite fussy in who you allow to move into the property, And I will say, again, this is just all perspective because I can't use the word will or is. We already have 2 or 3 companies, most of them out of the Midwest, chatting with us right now about buying the community from ERC Homebuilders when it's only half full. They want to buy it before we even fill it up. Now that sounds like a little bit of a sale pitch, so I have to be careful with a statement like that, but it is the literal truth. I am on those calls, and so so whoever owns stock in this company now should be very happy because this first development is going very well. We have a follow-up one in a city called Wesley Chapel, about 40 units. We're looking at 100 units down in Bradenton. These are all suburbs of Tampa. Tampa has, as you may know, a $3 or $4 million metropolitan population, just 20 or 30 different cities that maybe you would never have heard of, but they're basically Tampa communities. So we are both pleased and, to be quite frank, Rod, a bit surprised. I didn't think we'd have 55 reservations in 3 or 4 weeks. That has surprised even me, and so we're obviously quite pumped over this.
That's good. When approximately, no guarantees, when do you expect that you may be branching out of Florida?
I think that our land acquisition capabilities are quite deep. We're at the risk of sounding immodest, that's one of our greatest skills. My principal partner in this business, Ryan Kennig, is a development construction partner. I come from the multifamily industry. I've operated real estate in 17 states. So our management team understands land. So where you will see us move away from hometown is where we find that by virtue of Reg A shareholding, by virtue of other capital that we joint venture with, to the degree that capital exceeds our availability of land inventory, then that obviously will force us out. You know, we will go to, we're already looking in Jacksonville, we're looking in Orlando. There are people right now pushing us to buy land in Dallas. I will probably wait before I go to Texas here, but this is the term I use is vanilla. This is a very vanilla form of development. It's very non-specialty. When you're developing real estate, you know, you can go into the hospital business, go into the hotel business. That is real sophisticated stuff, Rod. This is a little more vanilla. The investors on this call should know that they're investing in a product that is intellectually easier. It's an easier product to understand. It's an easier product to build. If I were an investor, I would like that. So it lends itself to an ability to spread around the country. So that will really be capital driven, Rod. It'll be driven by there being more money available to develop than there is land locally to buy.
Yeah, fair enough. That's a good answer. Thank you. I want to touch on liquidity with the caveat that some of this stuff hasn't happened yet, but there are marketplaces coming to fruition that are focusing on real estate securities that companies, that investors have purchased. So I don't know why it looks to me like my image is flickering, and I don't know why that is, so I apologize. Anyway, so the point here is that there are a couple that I think are quite good. One of them particularly is planning to go live later this year, and there will be because this is a public offering. You're buying, those of you who who buy shares in a Reg A Plus, typically like ERC Homebuilders 1. These are shares that the SEC says yes, these are publicly tradable shares if there's a venue in which to trade them. So these venues are coming along, and I think the one I'm thinking of in particular that's going live later this year will offer the potential for, I think it's going to be relatively attractive and straightforward for Jerry and for other companies that we're helping raise money in Reg A Plus to list themselves there in a way that doesn't allow for naked short stock selling. It only allows for buyers and sellers and buyers to deal with each other. Until they finalized it and go live, that's when Jerry will be making the decision for ERC Homebuilders as to how viable it will be. So I'm not saying he's going to or not going to do it. I think he probably will want to, because from what I've seen, it looks good to me, and I like that better than some of the other options, frankly. So I just wanted to put that on the table for you guys. Hope I didn't muddy the water, but actually clarify something for you there. So let's see, other things we should touch on here. Don't forget, you're welcome to put questions in the comment box, the chat box, where where you click on chat at the center bottom of the Windows screen. At least you're welcome to give us questions that we can answer. Going back to the list of questions that we already have. Build to rent reference, yeah, that's good. Yeah, I think we've hit most of the high points here, Jerry. I'm thinking about something you just said, introduced a question to me, which is, if these are such easy homes to build, then why isn't everyone doing it?
Well, we're certainly not promoting that we're the only ones doing it. There's nothing. Homes have been built for centuries.
Mm-hmm.
I think that the and there's major companies, DR Horton, Lennar, Pulte. I mean, these are huge companies, do billions of dollars worth of this a year. This is a unique little niche. It's extremely affordable. It's extremely fast. It's extremely simple.
Mm-hmm.
Shareholders here should know that what we're planning now in this size, say 60, 70, even as many as 100 units, anything up to 100 units, I am projecting that once we spend money on the land, which basically commences the development, that these assets should be sold and cashed out by the end of 12 months. That's a very major representation. Again, I'm saying should be, Federal law requires me to say that. We have every reason to predict that. That's what's called a very liquid turn. We call that a liquid turn.
Mhm.
And are we going to be the only company doing this? By no means. This will be done all over the place. Are we one of the only company doing it offering Reg A shareholding? Right now, we probably are, but that doesn't mean there won't be others. I think this is going to be an extremely popular venue. You are contemplating investing in a company that's going to deliver a 1,400 or so square foot home for under $1,500 a month that will in other neighborhoods cost as much as $2,000. The companies who are going to buy these communities from us love that affordability. They crave that. But I don't want anybody thinking that I'm sitting here saying we're going to be the only ones doing it. We, under Reg A, I think we are, but I don't really even know. You would know better than I do, Rod.
Yeah, I think in Reg A plus that's certainly the case. Yeah.
One of the things, I can get accused of getting extremely technical, and I could put this whole crowd to sleep with great ease. but I will tell you something. This is just an interesting little piece of math, and try to follow this. We're going to use approximately $2.5 million of your equity, your money, to do this Zephyr Hills project. That project is scheduled to, these are, I can't make projections. We are projecting that it may generate a profit that could be 6 to 8 times the level of dividend that we owe on that money to you investors. That's the kind of stuff, and of course, you're going to see this in our financial statements that we file. We have to do a semi-annual financial statement. We do an annual audited over these next few semi-annual periods. You will see this. It'll be much easier to talk about historically than it is prospectively, but that's the kind of stuff that gets me excited. Are we at least projecting that we're going to profit well in excess of what the dividend amount is that goes to you folks? Of course, you share in that. That's why dividends would then go up. That's why there would be growth in the stock. From my position on the bus here, I don't view it to be my job to talk you into buying shares. That's not my job. My job is to do my best to see that you understand what you're buying if you do. And there's a big difference. We take this role with Reg A shareholders extremely seriously. I've dealt with investors for half a century, and we've done very well in all the different venues that we have. You have a possibility of investing with a company that is going to profit well in excess of its dividend requirements. That is the kind of language you want to be thinking about when you do something. This company puts $5 million into something, that's going to, 400,000 that has to go out in dividends. Can the company make 400,000 to cover those dividends? And I'm telling you, you've got a chairman on the phone that has overwhelming confidence that we're going to do way better than that. And you will see that in the financials as they get delivered, over time. And I am always available by telephone and email to have lengthy discussions. I think there's people on this webinar with whom I have spoken already, actually. And I'm very willing to explain that better to the degree I can. All with the caveat that it's all, should happen. Can't say will, it's all should.
Right. So two questions from the audience. One is, how are you able to rent these homes at such reduced rental amounts? And do the people who've made reservations put a cash deposit down, or is it just a representation?
Well, let's do the second question first. A very logical question. Of course, we will take cash deposits. We can't take cash deposits until we own the land, which is next week, and that's when it all becomes official. So what these are called, you would call these soft reservations. A soft reservation means it's a statement of interest. Will all 55 of those people give deposits? Of course they won't. Some of them will fade away. I haven't even decided yet what the deposit's going to be, but I am advising you that deposit's probably going to be pretty stiff. When you have that much demand, that allows me to come in with a pretty stiff deposit to make sure that tenant not only can afford it, but is serious about doing it. The affordability factor is strictly a function of the cost. We're using some modular techniques. We're using some techniques that speed up construction very fast without diminishing any quality. and we are simply putting these homes together at a cheap enough price that that's all we have to rent it for. And there are other competitors who are doing this kind of housing, modular aspects and so forth, and charging similar prices. What we have judged is that in this Zephyr Hills project, this 1,400 or so rent level is being charged in other communities for homes that are in some cases as much as 30 years old. So we think that's why we think we've got this reservation list. It makes me wonder, frankly, what I'm going to do with the rent. I may charge more. I don't know. We don't have to make those decisions yet. But rent is strictly a function of cost. And the rate of return we need to get after we pay expenses, and frankly, the net income that the community generates, how that projects to the company that comes in and buys the community from us.
Another question, couple of questions in one really, which is, will these neighborhoods have pools, jacuzzis, tennis courts, and will they have homeowners associations to go with that?
There won't be homeowners associations because they are not homeowners. Okay, they're tenants. So unless and until either a local or a state agency requires that, like a tenant association, there could be. We know nothing of that right yet. The amenity factor is a function of the size of the community. This 60-unit facility in Zephyr Hills will not have that. It won't have a swimming pool, won't have tennis courts. We do a 200-unit community somewhere, it likely will. That's all a function of how much room there is available. Let me explain that again so you understand how I look at stuff. You take a 60, it takes about 4 rental units of dedicated land to do a pool and some common area facility, maybe more. We lose 4 rental units out of 60, that leaves us 56. We can't afford that. We need to rent those spaces out. You give me 200 units and I take the same 4 or 5 units away, it's a much smaller percentage. We survey that when we take the reservations, and what my asset manager is telling me right now is that there's just absolutely no back off in the fact that those amenities aren't there. So we will do them as they are affordable, but understand that the smaller the community, the less likely we will have those amenities.
And are the deposits for rental units refundable or not?
My guess is they probably are under Florida law. I'm going to have to be quite frank, Rod, I don't know in this exact venue. I'm not, believe me, we are not trying to get deposits to then not refund them. We're trying to rent the community up to good people. Someone might come up and say, geez, I got a job transfer. I lost my job. I'm the type of guy just gives them their deposit back. Why? Because we have such demand for the community. If we break ground and start moving, getting the homes ready to rent out, and I've got a waiting list of 50 or 60 families beyond the 60 units, what do I care if somebody cancels? I don't want to get into a hassle with them. Of course I give them the money back. That's just kind of my nature, I think.
Yeah, okay, that's good. So I think we're reaching unless you have other questions in the audience, guys, I think we're getting to the end, the natural end of the session. Let me check how we're doing on time. That's good. For myself, I think we've covered most of the important things that I was expecting to cover. And what about, if you have anything else you want to volunteer, Jerry? Otherwise, we'll start moving to a close here.
Yeah, no, just feel free to email me at the email address and the phone number. I take calls from investors all the time. I love to have people understand what it is they're investing in. I would just love to see each and every one of you in this. I think you'd be glad you did it.
So my email and Jerry's email are in the chat box, so you can just grab them if you need them. And Jerry's is prominently available anyway in the communications that you received to invite you to the webinar too. So I think you're not short of an email address. So thank you very much, Jerry, and thanks.
My pleasure. Thank you, Rod. And thank you all for joining in today.
Yeah, thanks guys for joining us. I hope this has been a worthwhile session for you, and hopefully you'll hope it's been a worthwhile session for you. What more can I say? Hope the rest of your day goes well. Thank you very much for being here.